All right, good afternoon, everyone. Just 1 second. There we go. All right, you didn't come here to see me. You came here to learn what I think is going on in the markets right now. So I do have some guests joining, some family members as well that have never been on. And so, just by way of quick introduction, my name's Randy Taylor, and I've been trading for the past 38 years. OA1 Discipline Trading is a service that is a closed membership. Want to keep the community small and tight. This is a look behind the kimono, kind of taking a look and see what we do here on a daily basis and give some insight at this critical time of the market of what I think is going to happen and what we thought was going to happen has is now happened. And so, where do we go from here? So, with that caveat, I'll get myself off here, and we're going to focus on the markets. So, the first thing I want to do is you're not going to get a whole lot of empty commentary. We're going to get right to it. I want you, if you don't have in your notes, I want you to put in your notes outside bar equals caution. And what I mean by that is, for those that don't know what an outside bar is, bars charts are formed by daily high lows. Anytime that you get a high above the previous day high and a low below the previous day high, you want to circle that, and you want a red light or at least a yellow caution light to go off in your head and start thinking about the markets in a little bit different way. You'll see it happen the first time right here. This was the first outside bar. You see this day, and we traded above and below. We pushed up to all-time highs, came back down, formed another outside bar. We then proceeded to trade sideways, came up and retested this level several more times, created an outside bar near the very high, had an all-time high that immediately trapped after closing at an all-time high and began a downward move and had another outside bar, a sequence of 1, 2, 3, 4 outside bars during this span of December through February, early February. Write this down. And what you want to write down is not all outside bars result in a market correction, a market top. However, nearly every market top, short term top, whether it's trending or not, nearly every short term or correction is marked by an outside bar. That shouldn't be confusing. So sometimes that outside bar doesn't result in a market top, but almost every market top has an outside bar. Does that make sense? You could see this one right here, outside bar, perceived, precluded before coming into this drop down here. This was an outside bar. We had a big down move here. So not every outside bar equals a downward move, but every downward move generally is preceded by an outside bar. That you've probably never seen that or heard anyone give you such simple technical information is bizarre to me, but at the same time, it's what makes the market. And so I want you to add that in there. And when we first started this endeavor back in 2022, when we were working right here, I believe it was. Let's see. Actually, it was right there. It was in 2023. We had just were starting the service, and we had an outside bar literally the day before we went into beta live. When we came on for the very first time, my message to all of the new members was, I'm getting out of the market. I am going flat, and I'm going to then trade what I call the windshield. And that means I'm going to trade only what I see intraday. I am not going to say, well, here's a stock that I think might trend, and so I'm going to take a longer position in this. I get out of the market and I just trade a day trade. I'll trade intraday for that period of time until such time as I see either a definitive market bottom or that this is resolved without a correction by breaking to a new high. And I have a technical indicator that I use to say you're all clear at this point. So this right here opened up the door to a period of larger drops. This is another thing that you could write in your notes, and it's called a 3-wave rule. And generally, whenever I see a market turn over, the first thing that I look for is this wave down, a second wave down, and then a third wave down. That is called a 3-wave rule. And the reason I call it that is because the institutions generally will target 3 waves down as their formula for their market corrections. Now, bear markets are different. So this was a correction. This was not a bear market. This was a correction. And the difference between a correction and a bear market is stark. So it's important to know that as well. So let's come back into our current situation. We had a period of sideways movement that started having these outside bars. And generally, we don't have those outside bars. We didn't have any through this whole sequence here until we got up into this top range. And then we started seeing them in repetition. My caution light went out, went on at that point. And then I made the decision on this one here that I was going to be getting out of the market. Now, that wasn't the high, but it was enough of the information combined with other things that I watch to get me out of the market and to make the message clear to everyone that I was going cash in my trading accounts. I have multiple accounts. I manage multiple accounts. We have members that do everything from tens of millions of dollars all the way down to several $1,000s. So it's very difficult to talk across all of those various account sizes. So sometimes just a plain, I'm going cash is the way to convey a pretty clear message. I'm going to cash on my trading account. I'm taking everything out and I'm going to cash. I'm going to trade what I see intraday for now. So if I see a breakout of a particular stock, I will take that trade for the day. But I will generally be at cash at the end of the day. Every once in a while, if I see a break and it has a specific close that I look for, I will hold it into the next day or even longer, depending on what I'm looking at. But in general, this was told to members, I'm going cash. And from that point forward, in my other accounts, which is long positions, if I have just long stocks, your Apples, your Nvidias, your Meta, Netflix, and CRM, and whatever else that you happen to have in your portfolios, doesn't matter the portfolio. I am going to, at the same time I go cash in my cash account, I am going to start buying put levels down on my stocks. So if I have a stock that's at $500, I will start targeting layered puts. And generally what I'm going to do is look for support levels. So I would look at this as a support level where it pivoted. And I would say, okay, I want to be somewhere at 575 from up here with a put. I want a 575 put. And then I want to just keep looking back level to level, and I'll put puts out up to 2-3 levels of puts on shares. In the macro market, I'll generally trade what I see, but what we did is we My call was to take June SPY 440 puts because they were cheap. And since you don't have confirmation of a breakdown, it's better to go out further and go cheap because the impact as this would move up, for example, when this moved up, the impact, if you did something overnight or if you did something a week out, the impact's going to be 30, 50, 70% against you. If you're out to June, it's like 3, 5%. It's not going to hurt you as much. So you can be wrong and not be punished for that. So we went out to SPY 440 June calls. That was just my warning bell position. So took 200 of those. I've had up to 250 of them, but we've traded them along the way. So we traded them and sold some. I'm not going to really get into that because we're here to talk about now what's next. So what happened is the market turned over. I had given the members my technical read was 550. So when we were up here, I was saying, I think that the markets, if it's a correction, we will get to 550 for correction. If it's beyond 550, I think it is a recessionary or a bearish signal that's going to be given. Well, the night that we came down here, and I don't have overnight trading turned on, but right here we hit 549.68. It was lower than that in the overnight. We bought shares of Meta, of some different stocks. I put that in the overnight session for people that love to see me posting at 1 a.m. and 3 a.m. and everything like that. I will post those, as well as we bought futures contracts, calls, futures. Because 550 to me, I had predetermined that this was where I saw the market giving us a bounce, and either that bounce could lead to the end of a correction or it could turn over. We don't know that. What I did feel confident in is that we would get the bounce at 550. We did. It bounced initially. It had a little bit of a pullback and then it made a high. And so Meta, we peeled off $26, $27 a share. Everything that we went into, big earnings, just really good ROI on those futures calls. Everything made us money. It came back down to 550. We traded it again this time, not when it hit 550. It dropped down all the way to 546.87. But when we saw the volume crescendo into a V bottom that day, back when it was coming up through 550, we went long a second time. And then we took money out through this period here. So it was very short duration trades that we're making. Then we lost 550 in the overnight, and 550 dropped immediately down. So we cycled then looking for put opportunities. Below 550, I was convinced we were going to go down. I had also given a message to members that below 538, I think the acceleration factor comes in and you have an accelerated downward move below 538. And you could see what they did is they took it to 536.70 in the after hours. It continued down and opened, took the gap away. So if you were waiting for that 538, you would have missed this entire move. You almost had to just trust that closed below 538, that I was going to be correct and we were going down, and make sure you buy your puts at additional put levels at that point. We also then looked for trades, and I want to show you how you want to look for trades in stocks. CVNA, we had a trade here on a wedge trade, and I like to use the 30-minute wedge for trading. Okay, we had a wedge trade here on that's a current wedge. We had a wedge trade on CVNA that if it broke 212.33 to take a long position. Well, it opened down here. It broke up above 212.33 that morning, and it proceeded to run all the way up to $230. Now, the market at this point has turned over. It is starting to come down. And yet CVNA is pushing higher. That alerted me that this could be potentially a clear out move, getting rid of weak short holders. So if I have shares short, the institutions will push a stock up higher artificially to get rid of you. Why? So that you don't get the benefit of riding a stock down. So what we did is the next morning we were watching CVNA, and the moment that it broke a technical to the downside, which was right here, we took a put position in CVNA. It proceeded to drop $16, I believe, that day. I can't remember. It was a nice big drop. And then what we did is we took the money, because these were weekly puts that we went in, and we went out to this past Friday. We went to 170 puts, and it proceeded to drop down all the way then into where it's at now. So when the market is accelerating down, these are exciting times for traders, because when you know how to take advantage of failures in the market and understand how institutions work, you can make a ton of money, a lot more than a buy and hold strategy will do. And I have nothing against buy and hold. I have a tremendous number of buy and hold stocks over the years, but I don't just let them sit. I will use put protection, and I'm going to go to that next. And that is that when you have a stock, let's say that you own CVNA, and you see that outside bar in SPY, when you see these outside bars starting in SPY to sequence, get back on the daily, then I'm going to come, let's say that I own CVNA. I did not, but let's say that I did. And I see SPY pushing up, and this is where the top was in SPY. This was the all-time high in SPY. I own CVNA. I'm not just going to say, okay, I'm just going to keep dollar cost averaging into the stock and do nothing else, because stock markets generally always will eventually go up. Why would anyone in their right mind have that philosophy if you had the wherewithal to understand the market dynamics and then start taking put protection levels down to protect you from losing $100 plus a share when you don't need to be feeling that impact? And in fact, if you followed the protocol, you would actually be green through this period, because each one of those levels down will actually increase the value of your account versus the decrease of the stock value. Now, these are things that I show, right? I train to teach people to do that, of what they need to do to make sure that they do not let the institutions win. This is all about war. Institutions are in war against you, and you have to recognize that. I've sat in New York next to multi-billion-dollar fund managers. They think it is a wonderful, fun game to trick you out of your money. They have programs that run. Everything that is running in the market is by programs. And with AI coming to the forefront now, it's become even more difficult to understand everything that you're seeing on the price action and the screen. But understand and put it in your notes, everything is run by algorithms and computers and artificial intelligence, all of it. Now, they may flip a switch and wait to a certain point to flip a certain type of switch, a buy sell program, right? A squeeze program, something, a trap program. But once that is initiated, it is all algorithms and computers running it. There is not a human sitting there saying buy, sell, like some Wall Street thing of holding up cards and buying and selling shares. Those days are gone. And you've heard of high frequency trading probably. Well, that's a whole nother level where they're working the markets over for small gains over high frequency periods of time. So that's your competition. You're competing against those people. And the sooner and better that you are at understanding how they operate, the better that you're going to be as a trader. Now, my last word in terms of trend. When you have a market that is trending upwards, I always use the word markets love excess. Well, what does that mean? What it means is when people were calling for tops here, thought they were crowing that they had gotten the top. See, we were right. They were wrong. Oh, well, this is it. They were wrong. They were wrong. They were wrong. They were wrong. Markets, once they broke this out of this consolidation, they run to excess. And you will think the market is done, and it is not done. Okay. The markets love excess. So once a directional move has begun, do not be thinking that we're near a top. And right now, I'm telling you, don't be thinking that you're near a bottom, because markets love excess. Institutional market makers, the people that have the billions and billions of dollars, they love excess. They will hunt for your liquidity. Where is the max pain point where I can get people to throw in the towel so that I can take all that volume of shares, creating a bottom, and then take the market up? That generally will happen when you see these huge volume spikes. They can't hide themselves in the market. So during down periods, you definitely want to start paying attention when you do get these big volume spikes, for at least a short-term bottom could possibly be forming. So right now we could have a short-term bottom that comes in after a big flush out move tomorrow. That's something that's kind of old school, frankly, where things sell off Thursday, Friday, and then open super hard down on Monday and then go up. They bounce up because it gets all that liquidity gets bought, and you end up with a bounce situation. If I was leaning for that tomorrow, of which way I would be leaning, if I saw a huge down open, that's the instinctive first thing I'm going to be thinking about. Okay. And you should too. Okay. If we open kind of flat, that would be a little bit more worrisome if you ask me. I want to see that flush out move. And you probably had a lot of margin calls. Again, if you understand options and know how to use puts, you should never be concerned about a margin call. It's a foreign entity to you. You never will have a margin call because you have a protection from losses. And when you do multiple, like I said, you can actually go green during these periods. And there's some other ways that you can help counteract a falling stock if your account isn't going green. And I'm not going to take the time to cover that right now, but we talk about that a lot during these periods of time, of what they need to do, what people need to do to protect themselves during this period. So I understand that most people are busy and they're working and they don't have time to manage their accounts. But I'll tell you this, if nothing else, if you just glance at your charts every once in a while, and if you see an outside bar after a long trend up, at least in your mind, start looking for where the last major support was. In this instance, it would have been here. See that? As long as that held, just a correction. Okay. So at least have that in your scope. This one here, it kind of violated this one, but immediately came back up and closed back above it. And then it violated it again and then held and came up. At least be aware of that. Okay. So that you know, and you know what? It doesn't hurt to take even a protective put. You could take one, and then if that does break down, add a second, add a third at that point. It doesn't hurt, especially on a stock. If I've moved up $100, why am I going to fret over spending $3, $4 of that gain to protect all of that gain? It's the biggest classic mistake. And I always compare it to insurance. You pay insurance premiums every day, every month, and during the year for something that is probably never going to happen. Lord willing, your house isn't going to burn down. You're not going to have a wreck. You're not going to need that insurance, right? You still pay those premiums every single month just in case. This is the same thing. When you have got yourself a warning level now that you understand there is potential trouble on the horizon, whether it is short term or whether it could turn into something worse and even longer term, you have now in your arsenal something that you can at least pay attention to and get yourself an account. Doesn't have, even if your 401k doesn't allow it, if you're not self-directed, open up an account and put your coffee money in there. And when you come to these periods of time, don't worry about your 401k, just buy the puts and let it be your regulator outside of your 401k fund. Let them keep matching it. Let it keep at dollar cost averaging, and you have the opportunity to make yourself a little extra nest egg there if you get these breakdowns that happen so many times on these all-time high outside bars. So now, where are we going from here? I want you to look at this in terms of structure. We have broken down through previous supports. So this level, you could see it came down, bounced up out of this pullback. It came down and bounced. That was a higher low. So when you have a higher low, you're looking for a higher high. It gave you a higher high. There just happened to be outside bars that immediately rejected and started selling off. So that's a whole nother ball game when you start seeing that double, triple tops going on in resistance. Those resistant tops are very important when you start seeing outside bars. Generally, these bigger outside bars that occur, something like this one, it's meant to hide the institutional activity. In other words, most professional traders are going to trade above and below these levels. And so what they'll do sometimes is they're trapped. So they opened it down here and people thought, oop, breakdown. And then it trapped them and it ran it right back up through the middle, the 50 fib of this, up towards the top of it. And this gives them all this time, all of these days. Most professional traders, they're watching and they're waiting to see which way these outside bars break, because generally you start seeing a trend out of those outside bars. And so that gives them cover to make big moves with you kind of being blind to what's going on exactly. Me personally, better part of valor, I start taking money off the table. I just start trading a little bit shorter phases and I start watching to see if we get multiple outside bars starting to form. So when I see this one right here, see that one? There was one right there. I didn't mark that one, but there it is. Okay. So when you start seeing multiple outside bars in sequence, going in a sideways market pattern that has resistance top that can't break out and sustain any type of a move, then that's when you start giving it more and more credence. And then when you start losing your previous high, okay, so our previous low, so here was a low, higher low, higher low. We lost that one, okay? We lost that one. And then this one became a pretty big pivot, right? Between this sequence here, when you lost that one, that's trouble. It came all the way back up from down. Green candle means up. So it started down here. It came all the way back up and retested that level to see if the bulls could reclaim and stop the bleeding. They could not. That's as far as it got. The next morning, it opened all the way down here. It came all the way back up and it retested a second time, although a little bit lower, which is also kind of to me, a warning sign. And then it turned back over again. Okay. And frankly, we had traded the first move. And then the second move, we were looking for a specific number that it didn't give us. And that in itself told me that the markets were in trouble, that it couldn't find that number that it should. If the bulls are in charge, technically it would have hit that number. It did not. That became a big warning sign to me when it turned right back down. So then we lost the 550. So now where are we heading? Well, we're going to now look at our levels. And what I like to do is I'm going to first give you a stock that I've been trading, AVGO. You could see AVGO topped out, went sideways, and then topped out, formed a wedge here, made a put trade when this wedge breaks. I love trading wedge breaks. So on a 30-minute, this was really easy to see. And you trade then the downside when that wedge breaks, and your stop would be right here. So it's not like you have a lot of risk. Technically, your stop was right here on this trade. And so you got in, and sure enough, you never were tested to get out. It just immediately collapsed down. And now it's collapsed all the way down to here. Well, look where it reversed on Friday. You see this? That's not my drawing. I do have a little line there that I drew. Let me get rid of that. Okay, that wick, that's just called a bottom wick. It wicked all the way back up and closed at the base of this red. If it's a red candle, at the base is the close. Okay, this 141.65 is at the top of this area here. Now, what I call this, and what it's called, I don't call it, it's actually called this by a gentleman named Darvis. It's called a Darvis box. And that is when you have a series of high lows within a collapsed zone, back and forth. That's called a Darvis box. I usually will drag that down, draw it down to the highest body candle, which would be right there. You see this one right here in the sequence. So I'll usually draw that. Let me get it up there, right there. You see that? I'll put it there. To me, if that gets broken after this sequence here, I can't train everything here. I'm trying to tell you what the market's going to do, in my opinion. Then when I see this going back down, I think it's going to come to the base. The lowest body right here, close, was right there. That's where I target the stock to come back to. Okay. Sometimes this one, it didn't reach there. And that happens to be also a kind of a sign. It was the pre-signal to the breakout attempt. Broke out, pulled back in the box, and then broke out again, and then started a move, came all the way back in, almost sideways through this period, much wider though. I wouldn't call this a Darvis box. This is. The one before that was tighter. You see this one? Okay. That was tighter. And then this one was even tighter when the stock was just getting started on its breakout move from a lengthy consolidation period, very, very tight, and then broke out very hard. When they break out of these boxes, you get some very huge volatile moves that you want to take advantage of. We're not really here to talk about Darvis box in that term. What we're here to talk about is, where would a natural place for a bounce move come in a stock that has had a major collapse? And the first opportunity for a bounce would be into the top of this Darvis box. That's exactly what happened here. Hey, exactly what you've got. So was that tradable? Yes, it was tradable. Absolutely. So now, once it makes that bounce, does that mean it's just going to continue on? Absolutely not. That's what trading the windshield means. It means that you're using a technical level to make a trade that's a high probability trade, and then you're going to be gone. You're going to take your money and you're going to be out of the market on that, because it's just like these stocks, they're so volatile right now. We could open this down at new lows below here inside the box this time, and it could fail all the way to the base, which would be my second area that I would look for a trade, is in the base of this box. So that becomes something that you look for. If this fails, if we are going out of just a scare of a recession, you see everyone's talking about recession. JP Morgan came out Friday and said, now we think that we're more likely to enter a recession. Thank you so much, JP Morgan, for coming to the rescue, down 1,000 points in the markets. I really appreciate, I'm sure all of the people appreciate your expertise. So now they're telling you that it's going to be a recession. So that's going to exacerbate. You're going to have margin calls probably in the overnight session into the open of the market. So yes, I would expect to see an exacerbation move down. I've got a technical level that I'm watching on this stock right here, just above this 121 area on there. That would be for me where I would be willing to take a trade opportunity. If this fails and we go into a full-blown recession and bear market, then this one is where you're going to target. we are going to blow through this and we're going to come all the way down, I think, below 100 on the market, okay, on AVGO, okay. So each one of these becomes, since they became major support, just think of it that way on the way down. Just think of it in reverse. That even if it's not the bottom, where would a natural bounce occur? Well, wherever all of the work and effort of creating a breakout support zone rested on. So it would be back into here. And then ultimately, a collapse and crash of the market would probably take you all the way back down to here. And I don't know, I don't think we're going to have a crash. I think that we're having a recession into a bear market. And I don't want to even discuss the politics behind it. It doesn't really matter. I was saying that there was going to be a recession early last year. I said that we're going to have a recession. I've already seen the blueprint of everything that I watched to say a recession's coming. I think it has about 10% to do with tariffs at this point. I don't think tariffs have hardly anything to do with it. I think it's convenient for the bears, right, for the institutions, to get some fear mongering going on. But personally, I don't think tariffs, if you've studied tariffs over the years, I don't think tariffs are the reason this is happening. I think that it can be a self-fulfilling psychological philosophy, but I don't think that's the reason it's happening. There was a much worse dynamic at play that was going to lead to a recession. And so do I think now that it can be avoided? Perhaps, because what you have is a ripping of the bandage type of a policy going on right now versus a slow, more deliberate approach. You could argue the merits between the two. I'm not here to do that. I'm here to trade. So all I can do is trade what the screen's telling me. And what the screen told me is that we were going to drop. What the screen's telling me is that we may have a bounce in this zone with a little bit lower, a bounce, but that may not be the end of it. And that becomes the next stage of then watching of the markets. So you'd want to watch a bounce, just so you know, if you're going to look at AVGO, you have a gap right here. It's a very small one. You have a second gap right here. In my opinion, it would fill this gap, not only this one, but this one if you get a bounce move. Why? Because most bounce moves in a downward correcting market will make it somewhere to a 50 fib retrace from the high, previous high of the pattern down to the low. So where it broke down, take that high, this low, divide it by 2, and it's going to come in somewhere through here. That gets you a gap fill within that margin of error. And if you're long this stock because it's starting to push up, back up through this body here, is where I would take a trade personally. And if it started coming up through there, I would be targeting above this level into that gap closure, but I wouldn't wait for the gap closure, because the new algorithms out there know people are trading into gaps and they will stop it many times. You can go look back. They'll stop it right before the gap fills. In fact, here's a great example right there. You had a gap sitting there. This came all the way up, and I guarantee you there were traders saying that this is going to fill this gap and then we'll get out. And then it just went sideways. It never filled that gap. Okay. That's the new algorithms that I spotted about a year and a half ago that started running. They don't fill the gaps near as much anymore. Eventually, yes, they can. But generally in a sequence trade, depending on the market action, no, they will not. That's a new algorithm that's being run. You need to make a note of that, especially if you're a gap trader. Okay. So that's how you're wanting to watch the markets, level to level. If we continue correcting and we lose this level, I would look at the base here. If we lose that level, I would look at the top here into here. Somewhere between there and there would be your next probable bounce opportunity. And I would probably target there to here as kind of my zone of interest to watch for a volume spike, a V bottom into that zone, or a hard opening drop that recovers back up through. I would take that trade on there. Very quickly, we talked during phases of the market. When you are in a correction, There are defensive stocks that you'll see the markets go to. They flock to these like for safety, a flight to safety for defensive stocks. These would be stocks like AMT. They're cash heavy and cash rich. So when the market started coming down, you see AMT broke out and made a move up. You see AWK, one that I was very high on, making a breakout of this wedge and then starting a nice defensive move up. Post, right? Everyone eats their cereal. So it broke out with a gap, took away the ability to trade the break of the wedge by opening up here. So you just had to make a decision. Do I think it's going to trend up or not? So they took that away from you. And then ABBV is another one. All of these defensive trades I gave and said, if you're going to go with cash right now in the market, get into these defensive trades and let them go out. But when we started testing 550, I made the proclamation, get out, because defensive stocks are only good during corrections. They are not good during recessions. And if we're going to enter a recession, then they will lose. And so this wedge right here would have been a beautiful, I didn't trade it, but I'm just saying, I called this out. I was gone. I put this as a trade to the group. And I was out that day. And I think that was Friday, wasn't it? And I just said, guys, my top pick is ABBV. And if it pushes up to clear out the shorts and then drops down through, I would take then the put trade. And you had a nice, huge gain because now these stocks are going to turn over. All of them are going to turn over. And you saw AMT already started. Okay. And it also, that could be an outside bar. I hadn't studied it. It sure looks like one to me. So there's you another case of an outside bar that could move back up, and it could take, again, it allows the institutions to hide their moves right now. It could bounce up, clear out some shorts. I would be then watching a wedge on AMT that's going to be formed, and I would use a 30-minute wedge. And you're going to see a wedge form to the upside. Okay, right now you only got 2 points of contact. I like at least 3. So you would have to make a decision. If this lost this, I would wait for it to lose this and then take a put position. This right here is a good example of a wedge up. Okay, that would be 3 touch points. 1, 2, 3. Lose 219. Put that in your notes. I'm giving you a free trade. Below 219, I like puts on AMT. Okay, if you didn't already get in it, because I already told people these are going to turn over. If we're going into a recession, maybe that's what they're telling us as well. Markets are telling you something. I think you should listen to them. Okay, so that stock's telling you something. SJM. Okay, SJM had a big move, a clear out of a short, went to all-time highs here, or not all-time, sequence highs. Okay, cleared out, drew down, came back up within, and then couldn't break out and failed back down. And now, boom, again, 3 points of contact. When that loses this, I want to be short this stock. So you get short. And all of these stocks, I think these are probably some of your better plays right now because they've been trending up, and they're going to lose back down probably into this support zone. So down into the 112 for this one, etc. Okay. CVNA was the one I showed you earlier that we had a top trade pick was above 212, 30, 33. And as soon as it broke that 230, there's the technical. As soon as it broke it, I like the upside. Boom, big move up. But guess what? As soon as it broke this wedge down, it became, within the same week, it became a trade up, and it became my top trade the next day down. And we entered this, and a lot of members got in on this, and we made just a big move here. Our second one was Reddit. Reddit also had this wedge. They took the wedge away here, and you had this initial break of a shorter frame wedge, climbed back up above it. But when this wedge broke, we didn't get the initial of it, but we were also watching then where this wedged and continuation. We went ahead and went because of the macro market with this trade. And what you had on this, as I said, there's a huge gap sitting way back here at 82.98. Don't think it cannot get all the way down there. And sure enough, Friday, guess what we did? we filled the gap. Okay. And generally, when I get a gap fill, just put this in your notes. If you get a gap fill, if it's downward and you get a gap fill, you could probably trade a bounce move to the upside, because stocks generally will bounce when they fill a gap to the downside. When they fill a gap to the upside, they'll generally drop. Okay. So here was a small gap right here. It filled that gap, and then you got a drop. Write that down, make you money off of that. You should, I mean, these are not complicated things. It's not like chapters and chapters of books. This is straight common sense technicals I'm giving you that worked. They could work repeatedly over the years. They've worked, even with the algorithms, they work. And if that ever changes, I would make people aware of that, but they don't change it. Okay. So far, there's been no change in the structure. So where do I think SPY can go? Well, you have this right here. Okay. If I could draw it, you'll see it. I'm sure. There's my zero line. Okay. If I saw the markets lose these levels, and I've got a technical sitting right here, just around 494 or so, 493.80. Okay. There's a technical level there, and maybe that's what happens. Maybe we come down to that level on the big clear out move overnight tonight. If we do, I would be looking for mass volume coming in the overnight. And if they V'd, I personally would go with it. That's exactly what happened with Meta the night in the overnight during the summer last. We had Meta was one of the ones that I targeted, okay, was coming down. And in the overnight, it hit below 400 right here in the overnight session. By the time the markets opened, it was back above 400, never came back down below. Big round psychological numbers. Always be aware of those when a stock is moving. Okay. So when I saw the big volume coming in and the V occurred, I chased this stock to get it before it broke 400. It never looked back, and it gave immediately, without any retest, $100 per share plus move, and then went on into ultimate glory right there. Okay. So here's what I'm thinking on SPY. Okay. You could see where SPY is right now. Where are we close to right now? Again, I want you to use your common sense. God gave you some common sense. Let's use it. What is the closest big round number that we're sitting next to right now with Friday's close? You got it. 500. Fantastic. I think there's no way. Personally, I don't think there's any way we don't break 500. That's me personally. I think that if the markets want to create some fear and panic, you just break 500 and it'll become a news event unto itself. And so I personally think they break 500. Now, it could happen in the overnight and it could reclaim by the open. So again, I'm going to be a wide-eyed, firefighter tonight, watching the market. There's periods of time where you just say, I can sleep anytime. But when I have opportunities to make those type of returns, I'm going to be awake. And so I'm going to watch, and I'm going to see if we open down when the market's open at 5, the pre-market overnight session is 5 p.m. Central Time. And I'm going to look and see. And I'm going to see if it opens below 500, if it's at 501, 502, wherever it's at. And then my thought process is I think it's going to lose 500. Could it reach all the way down then into that technical? Hey, that I have right in here below 490, it wouldn't surprise me because momentum, it's already created 2 gaps down. Okay. So you have momentum going in the market to the downside. That's going to take enormous volume to stop it, like turning around a big old barge, right? It takes a long time to turn them around. So you're going to, and I say that in a sequence of, maybe some hours and then maybe even some days. So when you look back at previous drops that dropped down, you could see these bottoms that form. You have momentum market, and it made a big drop here, and then it dropped all the way down. Right here was your bottom. It opened down right there and then ran all the way back, reclaimed this zone, and then started its move up. So I love looking for these huge flash down opportunities that are breakdowns, especially below key psychological numbers. Now, you also happen to have this low sitting right here, a 493.86. Okay. So you have a sequence low at 493.86 sitting here. You have all of this outside bar led to this, moved down all the way then to 495.43 was the low. So I would be watching for 495.43 and see how it's treated. See if you start seeing volume coming in, because that was also right here in this block order that you could see. Anytime you get these moves like that, that's a block order that's going on. So that's created this support mechanism here later on. Again, I don't have time to educate and train how all of that works and how to spot institutional activity, but I'm just saying I would be watching this zone somewhere between these two levels, under 500, and all the way down if it got really frothy with some margin calls and panic. Then I could see it breaking 490. That's $15 more down. This right here was a move of how much? 525 to 505. Okay. So that was a $20 drop in SPY range. And that's including then an additional gap move. So actually, it dropped over $30. SPY did from the previous close. So don't think that it can't go into some crazy low number, especially how markets tend to end these periods are with major capitulation lows. And if you're good at spotting them, you can take some trades. Now, here's my final thoughts. Okay. I think that the markets, and when you have news events that are mixed in, so you have countries right now that are saying they're willing to come to the table. I don't think a key country has said that yet. I think it would take a key country, out of the European Union, to come to the table. I think it would take, some Canada, also, for example, if you started seeing Canada acquiescing a meeting to discuss it, not so much Mexico, but Canada or one of the European unions or the European Union collectively. I think you're going to get a news-driven bounce. I don't know if that's the end of the correction or the recessionary move, because I think the die was cast. It's not Trump, and I don't like him personally. It doesn't have anything to do with what I think about him. It has to do with the market. It has to do with price action and fundamentals that I've been watching that led me to say a recession was going to be coming here in 2024 and or 2025. I thought there was going to be a recession. Ask the members. They know I've been harping on it. I think you're going to get a recession. I think it's going to be nasty. Okay. I think that it could be shortened because of the ripped bandage approach. I may not like it. I may have done it different. If I were, I would never want to be it. But if I were, I may have come up with a different approach to the issue of balance and equities for trade. But hey, he's the president. He made the decision. It's going to be ripping the bandage, which means deeper drops faster, which also means probably the end of the drop faster. It can happen as well. So, along with the lemons, you might have some lemonade come into here. But I don't think this is a one phase move. And I think that you should say, just like you did, wave one down, here's wave two down. Okay. Let me get me a bounce. Give me a bounce that comes all the way up potentially between here and here, the 50 fib, somewhere in the gap that doesn't fill the gap, maybe. Again, now I'm going into my speculation of how I would trade markets. Okay. Served me well over the years. And I'm just giving you, that's what this is about, is me telling you what I think would happen. If you get a big drawdown and it bounces back and reclaims the Friday low, I personally would enter long. I would enter long trades. And I think you would get a bounce and then just make sure that you trim so that you're protected from a loss. Okay. And that's what we follow as a disciplined approach. We do a trim at a certain level, and then we have a second trim, and then we watch level to level. And I just give level to level where I think the markets would go. Hey, if it breaks here, I think it's going to go to there. And we look for that level then to make our next sell. And then we look for the next level. And then ultimately, we're down to runners. Okay. We only have a few call options, for example, or puts left. So Friday, we would have not a whole lot of puts left on any short-term action until, and I want to go to NDX real quick. Hang on. Okay, so Friday, I was out. I told the group, I said I would watch for the markets to come back up. I can't remember, is somewhere right here, I think. What was it, guys? Someone help me out. I sent a screenshot from my phone since I wasn't available. It was somewhere right here. I said, if it gets back up to here, if it pops back up, I gave this, and I said I would re-enter your puts at that point. Okay. And again, there was technical reasons for that. Okay. I call this true resistance, not this. I call this true resistance. You get these flash moves above where I see then the market makers set up with block orders to sell, that they can't break it then back above after the flash move. That's what I call true resistance. So when it came back into that zone, I was like, I would take your puts again for Monday, because I do think we're going to have a nasty open Monday, or in the overnight at least. So into the puts, a lot of the guys went back into puts. Okay. A lot of them went into puts. And then what you got is you got a beautiful trim into the close so that you had no risk holding those over the weekend. Okay. Or you could just exit and say, man, that was fun. I got paid right now. I didn't even have to hold it over. You could do that. There's nothing wrong with that. Again, people are up to their own trades. I just tell them what I'm seeing, and then they can make their trades. So I think that's what you're going to see. I would be watching for a 50 fib move if you get a break. First 50 fib move would be against the Friday candle. That's where I would take 50% off of any trade that you go into. So if I take a trade, if I get a down move, and I would already be in personally, but if you waited and you got in on a reclaim of the Friday close, which was 505.28, I would watch the 5 minutes on that, make sure it's not a trap move that immediately goes down. It's okay if it goes down, if as long as it's holding in that range and then starts pushing, I would be in a trade then, and I would look for a 50 fib of this candle. So 525.87 plus 505.06 divided by 2, that's where you would take 50% of that trade off. Just bank it. Good, quick, easy money in my book. Okay. And then you would manage through, if you take 0-day expiration, you would manage then through this day. I wouldn't hold overnight. If you went out a few days, then yes, you could watch for a potential then Model T 50 fib between that high and this high is where I would see the markets finding resistance. And there is a technical back to my left that's somewhere right in this zone, by the way. Leads also, you got two technicals coming together. Generally, I pay attention to those, and you would be gone out of the trade. And you would just wait for the next setup. If you're in 401ks, or if you have long accounts, you have Roth accounts, you have anything like that, well, I wouldn't sell. Number one, it's too late. It's like you've already ingested the poison. You've already taken the big hit. So I would go just follow your normal dollar cost averaging approach that you've always done. I would continue to do that with one caveat. There is nothing wrong with buying a put protection on a stock, especially if you get a bounce on a stock. Let's say that AVGO drops back down to a new low or right at the low, and then it comes back up through, and you have from there down to here the 50 fib. When it gets up to there, you could bet your bottom dollar I would be taking at least a 145 put, and I would probably be taking a 145, and I would be looking to say what would be next. What would be next would be down here. okay, a 126 down to a 119, I would probably put a 120 put out 90 days to July. So I would take this put probably out to May 2nd. So you're not going to spend as much on that put. And then this one, you're not going to spend, you're going to spend a little bit more because it's out further. But hey, if the stock does happen to pull back and continue this correction into a recession, it will get there. I'm firmly convinced it'll get there. And so what you'll do is if it does get there, you'll then close out this put and you've avoided this entire loss into your next protective put. It's much better when you do it at the very beginning. Don't get me wrong. It's much better if you were already in this and you would have already had a put way up here. You would have had a second put right here, okay? And you would have had a third put right here. It would have been nice, right? If you had seen this video back then and you would have had at least this right here, a put at 220, okay, minimally, depending on how much you're up. If you've been in the stock a long time, I would probably push that up all the way to about a 238 to 240 personally, okay? But at least a 220 and then next level, okay? I would have 3 levels down, especially if I'm at the beginning of where I see a potential top. I will go 3 levels. If I'm wrong, if it breaks out to the upside, I'm going to take a loss on some of those, right? I'll probably lose 50% of my highest put premium. I'll probably lose 30% of that secondary premium. I'll probably lose 15% of the lowest premium. I don't care, okay? Because I'm protecting lots and lots of money, okay? Whether you're protecting millions or whether you're protecting thousands, it's still money, okay? And if I have a way to tell you, I think the markets are in big trouble here and you might as well take precaution, then it's just wise to do so. Now, if you're looking, how do I buy in this market? What if I'm looking to make some buys long in this market and take advantage of stocks like AVGO, like let's say Meta? Meta's all the way down. Hey, it wasn't that long ago that this thing was 740. It's now $240 down. Friday, I had told the group that if it flashed below 500, I was going to buy. Okay. The first flash generally below a big round number. Okay, here it was. There's 515 right here. Here was your flash move. You see that V? See it? Doesn't take a rocket scientist to see this V taking over this secondary candle right here. It broke above the previous high, back upwards. So I'm a buyer. Okay, I bought at 497, and I'm texting people, hey, we broke 500. Did you get your fills at 497 or whatever below 500? It proceeded then to push all the way up to 515. I was out at 513 personally. Okay, just took that for a quick trade. This period of time of high volatility, big round, this is kind of what SPY might look like, guys. Okay, you see how these big psychological numbers work against the average trader out there? They're just uneducated. I'm not, and that's not being sarcastic or mean. They don't understand market dynamics. When that lost this big round number, I had already pre-told everyone, be ready. If we lose 500, I'm a buyer of Meta. I'm going to watch it and I want to see this action and I want to be buying in this candle coming back up. And the closer that you bought at this candle, whether you bought here, whether you bought there, your exit is right here. You're not risking a whole lot. And that's what I call compression trading. Okay. I love to compression trade. When stocks are compressed against an area that I'm watching for a bottom, that's when I like to take trades because it's already going to tell me you're wrong. Get out. And I'm not going to second guess myself. I'm just going to get out. Okay. And occasionally it'll double bounce bottom and it'll get me out. And I'll miss the start of that trade, but I would have taken it again here. But I'll get fooled if it came down a second time. I just get out and then I'll just come right back in. That was very good. Give them a round of applause to the market makers. You did a good job. But you know what? I'm not your average trader. I didn't get burnt and then say, I'm not coming back in. No, I'm watching the technical and I'm going to go ahead and come back in hard. Okay. And the guys in the room know when I have a technical mark, like if I was wanting to sell here, okay, I knew it was going to go higher than that personally. Okay. I'm just telling you how I trade. If I had a sell to trade here and it stops right here, you see that? It stopped just below that. And I have my sell there. Ask the guys in the room. I will always raise my sell price. Why? Well, because if they're going to come up and test this now, this one's already tested just below that. They're going to flash it at least above that zone. Okay. You got to understand how computers work, the algorithms work. They're going to have to flash it above that zone now because people have already bailed at this zone. Oh, that got close and oh, I missed my opportunity, and they sell. So the markets will always hit a new high. I'm like 98% of the time you're going to be able to get a little bit higher high at least. Okay. And then whether you want to stay with the percentage all the way and see what kind of gains you can get, that's up to you. Okay. So generally a retest, by the way, and I'm just going to throw this out for you. You see that wedge? A retest generally is going to terminate at the base of that wedge into the top of that wedge. And if it violates that by trading, I'm going to get there in a minute, by trading above, then it's likely going to continue to go up. It's going to break that wedge resistance and go up. This one did perfectly. It wedged up right into the base of this wedge and then exacerbated up within this zone, and then it turned back over. I wasn't around, or that would have been another good trade that you could make. Okay. And then you could see it came back in and retested the base of that wedge, right? And then turned over. You had another trade sitting. You could have traded just Meta for the day and done very well. Okay. So that's short phase. Long phase. How do I get into Meta? Hey, Randy, I want Meta long term. How can I do that? I don't want to risk dropping. If you're saying that the markets could drop this thing down to, let's say, down to this level, 442. I don't want to lose $60. I don't want to lose 60 bucks. What if it loses that? I don't want to lose $160, right? I don't want to lose that. What do? Well, you buy a put is what you do. And you don't have to buy multiple puts. You could buy one put equals 100 shares, and you could buy 20 shares of Meta. Have 20 shares of Meta against 100 puts. When you buy a put, it's at a predefined price. It's a coupon. It has an expiration to it. You're paying a premium for the right to sell your shares sometime in the future at a predetermined price. Personally, what I would use is 470. I would want to be just above this base. So I would take a 470 to 475 put. I would buy 20 shares of Meta. These are going to cost you probably around $6 to $7. Okay. For May 2nd, probably like $10 to $12. And if earnings are in May, early May, even more than that, I would abandon Meta as a trade if earnings are coming in, because you get premiums on those. Okay. But in general, what you're doing is you're going to buy a put, and you're only going to buy a fraction of shares because, hey, if Meta were to find a bottom and it runs back up $100, it wouldn't be anything, by the way, to do so. If the markets find a bottom, it'll run 100. It'll run back to 600. Okay. And retest into that. And by the way, there was a sequence of 600 where below 600, you could short it. Above 600, you could go long. And for about 3 terms, it gave huge ROIs, breaking that 600 mark. Okay. Up or down. Okay. So I'm saying that I think that would be a good retest, 570 to 600. Well, from 500, if it opens down here, okay, and you get a move back up, that's even better in the overnight. And then you can go ahead and you're up $30 or $20. That's what happened in the summer, last summer. By the time the market opened, I was already up like 40 bucks. And so then you can buy yourself a put back down at a level of entry, for example. And if you only bought 20 shares of Meta, if it goes to 600, that's $2,000. If your put cost you $600, $800, who cares? Okay. If the stock drops down to 470, I would then go up to like 50 shares against that. So now you're 2 to 1. You've got 2 times downside protection against potential bottom of a big move up. So you don't have to fill out 100 shares just because you have 100 puts. And I showed the guys Friday. Uh, one of a relative, a small account where I wanted a new position in a stock, and I had snow. It was snow, and I had a put, and I had 35 shares of snow that was down $222. The put was up $358. So you were actually in the green because the stock just kept dropping, and I was just bite-sized taking small positions to build. I had started with 20. I bought another 5. I bought another 5. I think it was every $7.22 is how I calculated it. I was buying 5 shares. And I'm like, hey, just keep on dropping because now you're at the money. My put's at the money now. So if it wants to drop in the overnight, I can now buy with the strike price above where I'm buying. So the gap between my buy, let's say it's $130 put. If the stock's at 120, I've got $10 in gain by buying shares guaranteed by exercising that put. I could force someone to buy those shares at 130 if I had to. Now, that's not how I trade. I'm just saying you're protected 100% at that point. You can't lose on that. But anyway, so I'm giving you my thoughts on the market is that we are going to have an exacerbation low. I personally would look for a bounce below 500, and it could be exacerbated. It could be tremendous. It could go into the open of the market and get retail involved in that selling down. A lot of times they'll do it during the overnight so that if they're loading up, you can't, right? Because the average investor doesn't trade overnight. They don't even have access to do it. Okay. So, but if you do, then I would be watching for that V, like we showed you on Meta from Friday. I would be looking for something like that in the overnight session. And then you might buy yourself a stock that makes a huge move for you. And then you could take some protection. Like if it jumped all the way to the 50 fib and you had bought down here somewhere in the overnight, you could take some of the money off and say that was fun. And then use some of those profits to buy protection against any type of loss so that you have no risk now holding that stock. So the time frame of which you buy stocks, they say you can't time the market. No, but you can time your entries. Okay. You can take time right here where I'm like, I can't time whether the market's going to fail or not, but I can see from experience that I'm going to start taking puts and it happens to be the top. Okay. It didn't mean that I'm trying to time the market. I'm using information that over the years sound like taken right there. What I have acquired is a set of skills that I've attained over a number of years. And if you will just sell me your stock at this price, I'll leave you alone. But if you won't, I will find you. Anyway, sorry, I digress. I never do that, right, guys? But this is what I think is going to happen. Okay. I think you're going to have an exacerbation low. I would be watching instinctively for a reclaim. I would trade that for a bounce move. Okay. I don't know how far that bounce move would go. I would say I would be 98% sure it would reach Model T, the 50 fib of this candle. I would be about 70% sure that it reaches the 50 fib between this and here. High probability that it would push on up on that. It's a news-driven event also. So at any time, you could have someone say something. It could be Trump. It could be someone else of great power and authority overseas. You could, the Fed, someone could say something and it short circuit things as well. So you have to be mindful that when you have a news-driven cycle going on in tandem with what I thought was going to happen anyway, it exacerbates it. And so you have to obviously plan for that. That's why I like using puts. I like using protection on any long share. I would never buy shares long unless I'm doing it in the pre-market when I see a V, knowing that the second that that market opens, if I can trim, great. If I could trim as my protection, I might give it some time without doing a put. Okay. So if I buy Meta at 488 and it's at 507, I'll trim at 507. And then I might not take a put. Okay. Because I've already gained a number of dollars that I've taken out. And I'm sitting here going, okay, I know I can't lose now. Even if it went all the way back down and I got out where I bought it, I still made X amount on 25% of my shares. Okay. You could do it that way. So just depending on how the cycle of the market is. Write these numbers down. Okay. I'm going to go back to NDX. 16,773.2. 16,773.2. If you see that number, any flash below that reclaims, it would look like this. Let's say this is that number. Okay. Let's say that I had said that that's that number right there. Okay. If it flashes below that 16,773.2 and reclaims, I would go long. Write it down. 16,772.3 on the NDX. I would go long. Okay. If you're forced out, in other words, if that were to fail back then down below to a new low, I would get out. I would just get out of whatever you bought. I would just get out personally. Now you could give it 5 minutes and see if it's a double bottom. I'm not saying you just have to immediately sell, but what you don't want to do is just keep holding. Hey, maybe hope is not a strategy. Okay. Technicals are a strategy. Hope is not a strategy. Just go ahead and just say, okay, I tried it. It didn't work. I got this reversal, but then it fell right back down. I'm going to get out. Okay. Personally, I just say get out. The next level then down, if we were to exacerbate below that 16,771.60, write this down. And this to me would be a short-term hard bottom. I just don't see the markets making it below here without some type of a substantial bounce. In fact, if it dropped all the way to there, I would probably be buying huge because I think you would get even a bigger bounce off of that number than you would a shorter term bounce. Okay. That number is 15,347.5. 15,347.5. So a flash below that number that reclaims, that to me, you should hope for a collapse. You should hope the markets collapse into 15,348. I mean, you should just hope that it does because it makes trading a lot easier when you have a collapse down into a huge technical support zone in the market. And that's what you would have at that level is a huge technical support zone. Okay. So there's what you can do. Where do we go from here? We trade like we always trade. We trade the technicals. I encourage people that if you're long-term investing, if you're wanting to start buying stocks because you think that there's some value to be bought, if you can't buy puts, buy smaller share lots. Just start small. In fact, it's easier to buy going up on a stock that's moving upwards than it is to catch a falling knife. Okay. So you have the ability to play the falling knife game if you use puts. You can win the falling knife game. You can pray for the falling knife game. I want the stock just to keep dropping. I want snow at 119. I want it back. I want snow back where it bottomed out. Okay. I want snow right here. You give me snow at 107 with 130 puts. I own you. I own the market makers, right? I own them because they're going to give me then 50. I won't do more than 50 shares. I leave it at a 2-to-1 on my one put to 50 shares, for example, on a really small account. Okay. But I would go another 50 if you got me down here. Okay. Because not only am I locking in 50 shares times what, a 130 put, right? 110 to 130 is $20 times 50 shares. Not a bad return. Okay. Those cost me $138 for those puts. They closed Friday at like 358. 358 against loss right now of 223. Okay. So you bet I want it to fall. I want it to fall because it's given me then opportunity to buy against that put risk free. Okay. Those puts didn't cost me hardly anything at the time. Okay. Now premiums are getting more inflated. The longer we exacerbate down, the higher the premiums are. I mean, we were fretting over SPY puts because you could go $10 out of SPY puts, something that normally would cost you maybe 80 cents. We're costing you $4, $5 on Friday because of the premium value based on the VIX. Okay, you have a huge variation going on in stocks. It's going to make it where they're going to charge a huge premium for you to be in there. We still bought them. And then the stock came all the way back down, and we were able to trim and eliminate risk. But we were still buying them because the generally markets don't bottom on a Friday with this cycle. Okay, very rarely will you get a Friday. Usually, it's an ugly opening Monday. Okay, so if you're looking for stocks that you're wanting to buy, I would pull up charts and I would look at the last support. Now that one's broken, I would be watching here, and that's where my put would be. For example, if I was going to buy some PLTR shares, I would buy a 63 put out to May 2nd, and I would buy 20 shares of PLTR. Then as it moved down into this, I would get no more than 50 shares when this dropped into the money. That would be it. Okay. Uh, do you like probability of new all-times high this year or not? Oh, man. I tell you what, I got to find a bottom on the market first right now. And then I can answer that question more with a higher probability. It would be a random guess right now. Understand that in general, markets favor upside over the long haul. And the reason why, it's kind of a rigged game long term, right? Because everybody's putting money in their 401ks and it's matched, and those monies find their way into the funds, and those funds find their way into various stocks. Your job as a trader is to figure out which stocks the funds are buying the most so that you could get in there and ride with them, right? But it is generally ultimately, upside is where we go, unless you get into a 1929 event, right? And then it can take several years before you're going to see anything there. So I don't think no. Now I will answer that question. Do I think that's what we're heading for? Absolutely not. No, I don't think we're going into that type of a phase at all. How far can we go down? Well, I think that I bought those. I told people to buy those 440 SPY puts for June with a purpose. Okay. It wasn't just random. Okay. It's because of this right here. This is where, I would say worst case scenario I could see right now in my windshield. Okay. And my windshield is for day trading, but my windshield is also for looking out to the future and saying, hey, look at those mountains in the future, right? Or look at that valley in the future. So if I'm doing that right now, I'm saying that I could see the markets getting all the way down into this zone. Okay. And I could, yeah. So somewhere between there and here, right there. So that's not that far, is it? Right here. I mean, we're closer to 440 than we are the highs right now, right? When we were getting the 440s, I mean, it looked a long way away. It doesn't look very far right now, does it? It's getting pretty big in your eyes. And so, I mean, those things that cost $1.20 something were over $8 on Friday. And so, of course, you're going to take some money off the table. at that juncture. And also you can follow a rule of now that the markets have shown that they are dropping, you can move in closer with a strike as well. So you could just eliminate all your 440s, bank all that money. I mean, if you had 10 of them, you made $8,000. If you put $1,200 in, you're up $8,000. Take the money, right? And then you could just watch the market then. And personally, I would just wait after this opening. If you're trading for an opening drop to maybe maximize a profit, I would get out, and then I would wait for a bounce move, and then I would look for a wedge. Okay. And then I would watch for that wedge to break to start a new cycle down. So that's how these things happen. They stair step up. And the difference is when they're going up, you get to draw these all the way, just continually. Okay. You just get to, even during sideways periods, you can see this, right? You get to draw these. Okay. It's always this way, just boom, boom. See that? See that? Okay. Then you have this deep draw down here. So you're watching that for a breakout, right? So that's an uptrend. Guess what? The downtrend's just the opposite. And there's your first big one. Okay. You had this one right here that started it all. Okay. Right here. Right here. See it? See it? 3 points of contact. I like 3 points of contact. Okay. And when you get 3 points of contact and you get a break, to me, it's an odds trade. Your stop is right here. What are you risking? You're not risking a whole lot. You're compressed. This is when you want to take trades. I know 90% of traders aren't taking trades until here, and then they generally get caught in something like this and they get scared out right in the middle of a sequence. Terrible, just terrible trading fundamentals there. Okay, so trade the wedges. Okay, and I like the 30 minutes because they give you a pure look of what's going on, and you can watch those volume spikes. Okay, so you could watch those volume spikes, but I like the 30-minute wedge, and you could see it broke right here. Sometimes it'll come back up and test back into the wedge. That's absolutely okay. You can't get scared out when they retest the wedge. Okay, and then, but in a down market like now, elevator down market, you don't get a whole lot of retesting going on the initial drop because there's just too much negative sentiment right now. But then you had this wedge right here. You can see that wedge. It took it away from you, right? And the markets will do that too. So what I typically do is I'll draw my line. Get out of there. I'll draw my line straight across. See how this works? Again, I'm trying to give you simple things. You could read books till you're blue in the face. I'm telling you how to technical trade. And you know what? I don't even care what's going on with tariffs. I'm just technical trading. I'm just seeing what's going on in the market. Do I read a whole bunch on the other stuff? Yeah. But it all feeds into my technical analysis. So here's your wedge. Here's your block order down, right? Versus the block order up that breaks to the upside. That's a block order down. So you have from here up to here. If it breaks that, generally that means it busted the wedge up to an uptrend. It came right back up and retested, and you see that liquidity grab wick right there? That's where you want to go ahead. Personally, go ahead and take a trade to the downside. Don't even wait for the breakdown. Now, some people will say that's a mistake. In a downtrend market, I think it's the way to trade, okay? Because your stop is still going to be right there. Your stop's close. So when I see that wick in a zone that you're looking for, this is the natural retest right up into here. That's where you would expect it to move over. If you said, no, I'm going to wait for the wedge to break. Well, you woke up and there was your wedge. Now what are you going to do? Okay. You'll be able to get another trade. You'll be able to get this trade right here. It's a shorter phase, 30-minute trade. Okay. But it is a phase. It's just not going to offer you as much. It was a slower decline right through here. And then what are you going to do at the end of the day? Hey, it's kind of a tight range. Does that mean it's going to bounce, or it's kind of have a bounce and then drop, or maybe a bounce back up and fill this gap? It's very hard to hold that overnight again. Okay. But if you did, you got paid, but they took the trade away from you. So the market makers, they will steal your ability to take those trades. And that's why I like using the retests instead of the wedge breaks when I see a firm downtrend going on. Same thing on the uptrend. Okay, same thing on the uptrend. So when a stock is trending up, let me go to the daily here. So when it's trending upwards, okay, and here's your zone then. There's your high. Body close is right there, a little higher than that, about right there. And here's your base. You see it? This comes into that. I'm taking my trade because my stop is right here. Again, compression trading. This is when you want to be your most aggressive, in my opinion. I've got the markets have broken out of a longer term wedge. It came down to the 50 fib on a retrace from high, low, 50 fib retrace. It's now pushed up. It broke out. It retested, made a new high. We're trending up. I'm just going to keep drawing these levels. Okay, I'm just going to keep drawing that. I see this, and then I see this exacerbation low back into here. I'm taking the trade. Okay, and then you got yourself a gap up. Okay, so that, and yes, now here's the thing about sizing. You don't want to just say, I'm just going to burn my full account into this because he said this is a good time to trade. You size correctly. What is my risk tolerance? Because what if they gapped that down and it's a breakdown of the market, right? You gotta be ready to lose money. You're not going to win 100% of trades. We ran during uptrend. We run about a 92 to 93% success rate, off the charts. Okay, compares and competes with anybody in the world. I think. Okay, I think members think that too. Okay, and during a downtrend, this phase right here, you know what we traded? You know what my percentage trade was? 51%. I was only trading at 51% success rate because we were in this mixed master. That was telling me something on its own, right? We didn't take a bunch of trades. I think we took 6 to 8 trades. So it wasn't like a bunch of trades, but you're only getting 51% success rate. Now that in itself is telling you something. If I'm not getting a high percent rate of return on my trades, something's in my mind saying that's wrong. So I'm going to back off my trades. We made one trade with the Qs looking for a 50 fib, and it didn't make it to it before it turned back over on the Qs. It gave a trim. It gave a trim from where we entered. This was equivalent to, I believe, 550. So we took the Qs. It made it for a trim. I admit it. I got like, hey, this is going to go to the 50 fib probably. It did not. Generally, these removes will come back into the 50 fib, and there was a nice little top wick right there at the 50 fib that I was watching as well. It did not. Okay, it didn't get there, and so I took a loss. Okay, had to take a loss on that trade because it broke down. So once it sequenced though, and once we saw what was happening in that 550 loss, we've been 100% on our trades. We haven't had a losing trade. And that's because the beginning of a downturn is generally some of the easiest elevator down trades that you're going to get. It's not that I'm a great trader. It's just that I'm willing to trade almost. It's better to be in the market than not be in the market at those periods of time, right? So, I'll look at that tonight, guys. I'm not going to take any more time. I hope this has helped you guys understand what I'm seeing in the market. More importantly, I hope that you add the outside bar. It sounds so simple. Okay, I'm just telling you, when you have been on a long trend up and you start seeing outside bars in a sideways market, I get out, and I can always buy. I can always find a trade. I cannot recapture millions of dollars of loss. I can't do that. Okay. Can't do it. And neither should you. You can't recapture thousands of dollars of loss. So you need to be on your toes. Okay. When that happens. So you need to put that in your arsenal. That one thing right there, along with the 50 fib retrace, those are two of the most strong technicals that you can have in your arsenal. You could beat the market like a drum with those two technicals, and then wedge trading using these wedge breaks. Okay, so this one broke down below. It did drop after on the breakdown. It dropped pretty hard. down here. That's like $8 loss there. It bounced back up, and that looks about like just above the 50 fib from here to here, the 50 fib. And then it came and retested. And then you see this right here. This to me was a big clue for a short-term trade, is that wick tested into this wedge and failed. And that to me was a buy to short, okay, the market. And then you got a nice little trade out of there. So we're windshield trading. We weren't trading long other than those 440 SPY puts. Okay, we weren't trading, well, 440 SPY June 20th puts, and taking 2 to 3 levels of puts on our long positions. So I had, I've got all of the big players. I've got Microsoft. I've got all of these big traders. So you can bet I was buying puts. I think I took a 432 or 432.50, somewhere in there. And then I had a 410. And then I had a 370 that came all the way back into this zone, right through here, into this breakout. So I had this strike also on a put. So I took 3 levels of puts on there, and I got to close the first one out when it made it to the second one. So you made all of that money, plus the premiums were juiced by that time on the second and third one. And then as it came into the third one, I can get rid of this one. Okay. And now all I have to do is determine on tomorrow, if we get the flash down, push back up, I will use that to buy another new second level down put at a predetermined level. Okay. And that would probably be somewhere in this zone right here. Okay. In this, I'll have to technically figure it out, but it'll be somewhere in here. I'll get a second put, and I don't think I'll do a third. I'll just do 2 now. So that'll be a total of 4 puts that I will have traded on this stock. 3 at the beginning, get rid of 2, and then look to get a second one here for these 2 then. So a total of 4 puts. Okay. And that'll be out to probably at least June, probably July is what I'll do. And again, look, if you're up from 240, okay, if you're up from 240 to 260, okay, to 460, that's $220. And I'm going to spend maybe $22 in put protection. I will do that all day long when I see technicals that tell me you're potentially seeing trouble signs. I will put that money out there. And I'm not risking all 220, because if the markets break to the upside, I just take the loss. And maybe I'll lose $16 of the 22. Again, you pay insurance for everything in your life that's of value. What is better value than your money? So pay the insurance, guys, and then you'll end up winning in these periods of time. Okay. Appreciate you guys. I will, this will be available to members recorded. And like I said, it did go a lot longer than I thought it would. All right.